And look, judging from the ADP jobs report today, looks like the trend is your friend. Jobs are going up. Do you think that there's any chance that the Fed is not going to raise rates here?
I believe the 100% probability that you mentioned, Betty, because I think with the 298,000 jobs created in the private sector that ADP spoke about, it looks like the Friday jobs report is going to be more than decent. The consensus is expecting 190,000. So as a result of that, if it's going to be 190,000 or better, the Fed goes on. What could stop it in the last minute on March 15th, if you have indications that the Netherlands elections is going to bring forth a far-right candidate, or if you see the French debt spreads rising before the Netherlands election because of expectation of more turbulence in Europe, they may put it off. But I think if they do that, they're going to lose even more credibility during the months to come.
Exactly. It's got to be so bad that it justifies holding off, Sri.
Exactly.
But this is interesting. You say buy treasuries right now, and I want to just pull up a chart. Guys, let's pull up chart 6595 that shows you for this month, treasuries are going to, or in the last month, they've come in at a loss. Which is the first time so far this year, just based on right now all these expectations of a Fed rate hike. So why do you say buy now?
Now, if you look at where the treasuries are, Betty, the 10-year treasury is yielding 2.56 today. And that is based on the expectation that not only that the Fed is going to hike March 15th, but you're also going to have inflation pick up. Growth is going to be very robust. I don't believe either of them is going to happen. On the inflation front, you saw the 5% fall in oil prices today. And as the Fed hikes interest rate and the dollar becomes strong, even stronger next week, that is going to be negative for oil and inflation. And one reason why inflation perked up in recent months is the higher price of oil. So that's going to be reversed. The final point, the third reason why I'm optimistic on U.S. Treasuries is that you have the 10-year German Bund, the risk-free yield on the European side, yielding 36 basis points today, and the U.S. is at 256. The question is Germany so much less risky than the United States that you would accept 36 basis points? I don't think that to be the case at all. And I expect the two of them to move closer to each other. And that involves the U.S. Treasury yield going down.
So, Sri, yields could come down, but you're saying dollar could go up. It's interesting because I'm taking a look at the euro-dollar overnight volatility. You can throw up the chart, and it's quite low right now. They're not too concerned about this ECB meeting later on here today. Compared to the previous ECB meetings, we have actually seen volatility spring up. So are we underestimating the risk, the political risk in Europe right now?
I think we are underestimating the political risk, Yvonne. I think you have the expectation that the ECB will not do anything Thursday afternoon, Europe time, when they come out with the decision and Mario Draghi's press conference. However, look at what is happening with the different countries. You have Netherlands, France, even Germany, where an anti-Merkel candidate, if you will, Martin Schulz, is in fact gaining in the polls. So when you put it all together, and then you have the Brexit risk become real, and you have the Italian banking system risk, which is continuing to cause difficulties, risk increasing. Any one of them could go the wrong way, and I think the euro is too strong under the current setup when you take this all into account, which is why I look for the euro-dollar exchange rate to move toward parity, 1-to-1.
And real quickly here, Sri, we've seen kind of this leg down in stocks recently, but what could actually trigger something that spells maybe a correction, or are we just seeing a pullback right now?
Well, one thing that can pull back is if you see the many Trump campaign promises, which are what boosted equity prices in the last 2 months. If they see some of them not coming through, then on the trade front, if any drastic action is actually taken against China or Mexico rather than just threatened like so far, that would be very negative for equity prices as well. As long as you stay with threats and you don't do anything antagonistic toward China or Mexico, I see the equity markets remaining relatively benign shape.